Markets Now is brought to you by the 5-year anniversary of Brevant Seeds. Here's to 5 years of not just winning, but collecting one game-changing W after another. See all of our wins at brevant.com/wins.
And welcome to Markets Now. I'm Michelle Rook with Craig Turner of StoneX, and we're seeing mostly lower grain and cattle futures here as we start Wednesday. And Craig, let's talk just a little bit about the market. We're kind of in the grains marking time here until we get the WASDE report on Friday. A lot of speculation and even average trade guesses that we're going to see lower yields. The question is really just how much, right?
Yeah, that is. I mean, we saw Pro Farmer come out with a 182 after into their tour. We've seen some of the surveys, including StoneX, be lower than the 188.8 on corn. I think StoneX had us in the 170 area. I've seen 176s. Industry average around 186. So we're about 185, I think, on the average on corn there. And then for soybeans, WASDE last time around was 53.6. We're seeing some people with, either low 53s or high 52s on that. So what will be interesting is how much do they reduce this? For beans to be bullish, we probably have to be 52.5 or lower. That's where, if we take a full bushel off, all of a sudden we're getting close to 200 million on the ending stocks.
Okay.
Right. And that would be bullish. And then on the corn side, I mean, if we're 185, we're bringing down, yields by, 3 bushels off of, let's say, harvested acres or close to 90. That's 260, 270, 280 million bushels coming out of production, maybe. Not all of that, demand would probably come down too. So I would think, with, to get the new 10% stocks usage for corn is probably 1.6 billion now that we have higher use than we do in the past. So to get there, to get close to 10% stock to usage, we'd have to probably be under 185 on the yield, 184 on the yield to really get, corn, really bullish. I mean, something in lower yields are certainly help corn and soybeans here, but if we want to get to a place where we could have a potential situation where we may need to price ration exports, it's probably somewhere in that low 52 for beans, and it's got to be, I'm thinking, sub 185 for corn. So, and I don't know if the USDA will slash it that much, right? So, I mean, if we were 186, we could be on our way.
Probably not in this report, right, Craig?
Yeah, we could be on our way to get there, by January or so, but probably not in this report. So that's a good point.
So what is your sense right now, especially on corn, with the dryness and especially now the disease that we've heard, the heavy southern rust pressure? How much do you think that is decreasing yield?
It's interesting. I talk to farmers throughout the Midwest. You're hearing, I'm hearing things of fields where they're 20 or 30, bushels lower than, they thought they'd be. It's more widespread than we thought. There's still a crop out there, right? We're not going to be sub 180 on this, but the crop it does sound like it's getting smaller. We didn't have much rain. I mean, honestly, I think the conditions were probably best right before the WASDE had their last report. So again, it's not just going to be on a supply side. We also need the demand to be there. I mean, one of the things the USDA did do is, even though they had basically nearly a 17 billion, production, or 16.5 billion production in the last report, they did up the usage because they figured if the United States can have this much corn, it's going to win over a lot of demand on the feed. The ethanol is going to be strong, and the exports will be strong. So we'll see. I think, it does sound like there's issues out there. That 188.8 is definitely going to be a high water mark on there. But when the USDA does decrease these yields, they're going to probably bring down demand a little bit too, right? So that's be a net on the.
Right. So let's talk about demand on the soybean side too, because you said 52 yield might move the meter, but what if we don't get China back in? Do we have an adjustment right now in this report in terms of accounting for the fact that they haven't bought 1 bushel of new crop soybeans from the U.S. or not?
Yeah, it's concerning, right? Because, we're talking usually by the end of November, China's bought a majority of the soybeans in the United States, and here we are, and they haven't bought anything. And listen, could the US, I mean, the USDA could bring down bushels, let's say a full, maybe it goes a full bushel lower, and now all of a sudden, 90 million comes out of production, but they could certainly reduce exports by 90 million too. The crush is going to be strong. Hopefully we find a home for the meal. There's certainly be a home for soybean oil, just on the domestic front. But yeah, it's a concern for soybeans. And the thing is, even if things get tighter, like if we do go to 52 and a half or 52 on that yield, and let's say we do get tight on supply and the USDA doesn't, change too much on the exports, because they could make the argument that if China's not buying from us, they're buying from someone else, and that does displace a traditional customer, let's say from South America, that now has to come to the United States. Like we saw the same thing happened with Trump tariffs, the first time around in his first administration. Like we didn't get all the demand back, but we did get a lot of it back, from other countries. So I think that's already priced in. The thing is, we could go to $11. We could go above 11, on any kind of increased demand or South American weather issues or just tight US stocks from a smaller supply. But it's very difficult to go to 12 or 13 without China in the US market.
For sure, for sure. What's your sense right now in terms of how little new crop has been priced by producers going into harvest, and how much is that, and what's left to price for old crop hindering the market from going up as well?
Yeah, it's not even just that. I mean, feed wheat is cheap, corn is cheap. On the soybean side, as we are crushing for oil, basically the meal. I mean, exports for meal have been actually pretty good, but they have to be like meal has to go low enough to get export demand on feed, versus, when it competes against corn and feed wheat. So not only do we have those issues, but we do have old crop that, still either needs to be priced. We're going to have a whole bunch of new crop that's going to, either not everything can go into storage, but that's why the commodity market, that's why the grain and oilseed markets tend to bottom out by the end of September. In years where we have tight stocks, we'll bottom out by the end of August. In years where we're adequate, it'll bottom out sometimes in that first half of September, where you got burdensome supply and a big crop coming out of harvest. It's usually the end of September, early October. Um, I think that pattern. I think that pattern. If we bottom out sometime between mid-September and late September, that kind of makes sense for me. Just from where we sit, where stocks should be. But these prices, in theory, should help demand. But yeah, we're gonna be range bound. Corn, $4 is gonna probably be a pretty good value. $10 for beans, but again, it's gonna be difficult for corn to go over 440, 450 with all the supply, on hand, and it's really difficult for soybeans to get through the upper tens,
Right.
without any kind of Chinese buying.
And wheat has struggled as well here to try to put a low in. What is, in your mind, the biggest problem right now that's holding the wheat market back?
All right. So all wheat is at 42, 43% stock to usage. That's bearish. I mean, when wheat was really low price, 2015 through 19, with unless we had an issue with like Crimea or, something to do with Ukraine and Russia, we just couldn't get a rally. And we were at nearly 50% stock to usage in that time frame. So hard red winter wheat is over 50%. That Kansas City contract is very bearish, where, um, it's going to be difficult to rally, let's say over $6. And if we get down to 5, let's say on Chicago wheat or lower, it implies 215, 220 a ton on the export market. And you will see some buying interest. Like we did see buying interest in wheat when we got that cheap. The thing is, like, then, you see the short covering, you see some spec buying, you go up 20 cents, 30 cents or so. And now the United States wheat isn't competitive anymore on the global export market. So to me, we're at a value area. It's got to stay low. Old crop has to stay low to keep on stimulating that demand when it becomes either cheap feed option here in the United States or for export. But what it also has to do is bring down acres. 2015 through 19, we did see wheat acres come down almost like 1 million acres a year. And the way wheat is priced now with the stock to usage, you'd actually think we'd come down 1 million or 1.5 million, for basically next year combined winter wheat and spring wheat planting. We'll see if that happens, but right now the market is screaming for the western part of the United States and also Western Canada to try to increase cattle, livestock, especially cattle production as much as possible. And we could see that at the expense of winter wheat out west. So there's a tipping point in every market. That could be happening now. When you take a look at cattle prices and wheat prices, that's more of a long-term story, but we're actually starting to see that, happen a little bit.
All right. What about the cattle market? Limit dem moves in feeders yesterday. We crashed through these 20-day moving averages. How big of a correction do you think we could see here?
Yeah, we haven't had a correction like this in a while. We've tested the 20-day. I don't remember the last time we were nearly down 10 points in feeders to actually close there, to close below a 20-day moving average. I think some people will point to there hasn't been a whole lot of news in the cash market to argue for that big, the big down days over the past, 2 trading sessions and today. But, when you take a look at the cattle on feed reports, you can start to make an argument. We may start being more neutral on the year over year numbers. When I talk to farmers out west in Canada and the United States, cattle prices are getting so high and the feed prices are so cheap, and you can use the markets to basically lock in some pretty decent margins here over the next couple of years if done correctly. Wheat isn't profitable to do here. So, I think the market that's been making its ways, through the trade desks and on podcasts and, on shows and in newsletters. So there's some fatigue out there in the cattle market. We'll see if it keeps up, and it's be very interesting to see what the cash trading is like later on by the end of the week.
Yeah. All right. So last question for you. PPI out this morning, down 0.1%, and the market was probably not expecting that. We had the jobs annualized yesterday down over 900,000. Mm-hmm. What does this mean for interest rates, and is this good news or bad news for the ag sector?
Okay, I think it's starting to build the case where we may see the Fed continue to be a little bit more friendly for interest rate cuts. The job market is weak, and the PPI number was fairly steady, right? So if that's the case, the Fed mandate is they want to have inflation in check, which it certainly seems like it is, and they want to have full employment, or as close to full employment as possible. I would think there is going to be a quarter point. I think it makes an argument for a quarter point, sometime between now and the end of the year. We'll see if that happens. I bet you'll hear more about it too in the financial press. And as far as commodity markets go, listen, we still have, if you take a look at the price of gold and silver, there's obviously money flowing into precious metals just because of, certain inflation concerns. If we start lowering interest rates again, the market, you'll see money flow into the grain markets. Thing is, maybe it's good for a 5 or 10%, maybe a 5% bump, which there's nothing wrong with that. But at the end of the day, to get the big moves in the commodity markets, it does come down to supply and demand issues. But it's certainly supportive, and it's another case to say, hey, if we're going to start lowering interest rates, it's another reason why corn, major supports at $4, and why major support for soybeans remains $10, and why we really shouldn't dip below $5 in wheat.
Good enough. Thanks so much for joining us. Craig Turner with StoneX. That is Markets Now.
You were right.
You were right.
You were right.
Well, you were right. When you choose your seed brand, there's winning, and then there's...
You were right. Should have gone with Brevant seeds.
When you choose Brevant seeds, you don't just win. You get to be right. Don't just win. Win. Talk with your retailer or visit Brevant.com/win to get started.